Welcome back to the deep dive. Today we're getting into something really interesting, a very structured way to look at markets. Okay, let's unpack this. Our focus is the core model, which its creator describes as a time-based trading system. And what really caught my eye is that they call it, quote, my favorite and most reliable. That's quite a statement.
It is a bold claim, yeah.
Yeah.
But hopefully this deep dive will show why. We'll basically break it down step by step. How it works, where it came from, the different phases. It's actually built on a pretty simple but powerful idea about market rhythm.
Right. So our mission today is to really get the logic behind it. Why does the creator feel it's so consistent, so reliable, especially when, trading can often feel pretty chaotic? So where does something like this even start? The source material says the core model actually began with an idea from someone named Romeo called 159 timing.
That's right, Romeo's 159 timing. It seems that was the initial spark, the core insight that got the author thinking along these lines. It wasn't just about picking hours, though. The real genius, it seems, was recognizing this sort of cycle, almost a psychological beat in the market that, frankly, most people miss. Building on that, the author then developed their own concepts. The 1 a.m. CRT, 5 a.m. CRT, and 9 a.m. CRT. CRT stands for Core Range Target. They'd shared stuff about these CRTs before, apparently in detailed threads, but the core model itself, that was kept pretty close to the chest initially.
Okay, so it builds on that 159 idea but adds more layers.
Exactly, more precision.
So at its heart, the core model is essentially a trading model based on time, focusing on specific 4-hour candles within the daily candle, specifically the 1 a.m., the 5 a.m., and the 9 a.m. candles. And just to be clear for everyone listening, all these times are New York time, UTC-5.
Yep, New York time. And if you step back and look at the big picture, the framework is actually quite intuitive. It kind of mirrors how a trading day often unfolds. The source puts it like this. The 1 a.m. candle usually forms a range. Simple enough. Then at 5 a.m., you often see some manipulation, a bit of trickery perhaps. Finally, the 9 a.m. candle is where the real expansion happens. That's the main move.
Range, manipulation, expansion. Okay, I like that structure. It's like a narrative for the day.
It really is, almost like the market telling a story in 3 acts.
All right, let's dive into Act 1 then. Phase 1, the 0100 a.m. range. This 1 a.m. London session 4-hour candle. That's the starting gun.
That's your absolute starting point. And its main job is pretty straightforward. Its primary task is to reach a POI, or a key level. POI meaning point of interest, basically, an important price level you've already marked out. And here's the crucial instruction, the one that trips people up. During this candle, we don't take any trades. We just wait.
Patience required immediately.
Exactly. And the author even notes this waiting. That's where most traders struggle. It's tempting to jump in, right? But this model says no, not yet.
So your job, as the trader listening, is simply to wait. Wait for that key level you mark to be hit. It's observation, not action.
Precisely. A shift in mindset from constantly needing to do something.
Okay, so you set the range, you're being patient, but then 5 a.m. rolls around. This brings us to phase 2, the 0500 a.m. manipulation. Things get a bit more tricky here, you said. Manipulation often occurs.
Yeah, this is where the market might try to fake you out. The author lays out 2 things to check, depending on what happened back at 1 a.m. It's very logical, like an if-then statement.
Okay, break that down for us.
Right. Scenario A, if that 1 a.m. candle did manage to reach and tap your key level, then your job is to wait and watch for price to either run above the 1 a.m. high or dip below the 1 a.m. low. Just a quick poke outside the range, that's the manipulation.
Got it. And scenario B.
Scenario B, if the 1 a.m. candle didn't quite reach your key level, then you still wait, but you're looking for something specific. You look for a raid or turtle soup on the CRT high or low.
The stop run.
Exactly. Price briefly pushes past the established high or low, grabs liquidity, and then reverses. You look for that along with manipulation into your key level so it clears the stops and hits the level it missed earlier.
That makes sense. It fulfills both objectives.
Correct. And the core principle here, the author stresses, is not to chase the price, it's to recognize it. You're not guessing, you're seeing the setup confirm itself.
And once you see that manipulation happen, that CRT high or low taken, what's next?
Then the next step is you start looking for Model 1. That's a specific entry pattern defined within this system, your signal to potentially get involved.
Okay, so the stage is set by the range, the market does its little manipulation dance, and now we hit 9 a.m., phase 3, 0900 a.m. expansion. This is where it gets really interesting, you said, where the main move is supposed to happen.
This is potentially the main event, yeah. According to the source, the 9 a.m. candle is set up perfectly for expansion if that 5 a.m. candle did its job. Meaning, the 5 a.m. candle takes out the CRT high or low and then closes back inside the 1 a.m. candle's range. That sequence is key.
Right. The manipulation happens, but then price snaps back inside the original range before 9 a.m. starts. That's the trigger.
That's the trigger indicating the manipulation is likely complete and the market's ready for its real move.
So how do you actually trade this 9 a.m. expansion? Are there specific entry techniques?
Yes, absolutely. Trading the 9 a.m. candle relies on OLHC principles, open, high, low close, or open, low, high close. It's about how the candle forms.
Okay.
So for a bullish setup, you're looking for the 9 a.m. candle to open, form the low first, and then set up an entry through Turtle Soup Model 1 or an OTE,
OTE.
optimal trade entry. It's a common Fibonacci retracement technique. Your target then is a high close for that 9 a.m. candle.
And bearish is just the opposite.
Exactly. For bearish, you look for price to open, form the high first, then set up your entry via Turtle Soup, Model 1, or OTE, targeting a low close for the candle.
So the initial move of the 9 a.m. candle helps you position. Using those specific patterns, Turtle Soup Model 1 or OTE, it's very structured.
Very structured. It's all about confirming the market's intention after the first two phases.
We've walked through the blueprint, the theory behind the core model. But theory is one thing. Seeing it work is another. The author kindly included some examples, right, to show what this looks like on a chart.
Yes, and they're really helpful. Let's start with example 101. This is the case where the 1 a.m. candle doesn't reach the key level initially.
Okay, so it falls short.
Right. So on the H4, the 4-hour chart, 1 a.m. sets the range, but no tap of the POI. Focus immediately shifts to the 5 a.m. candle. We're looking for that turtle soup of the CRT low and manipulation into the key level. In this specific example, the key level was a discount FVG.
FVG, fair value gap.
Correct, an inefficiency. And the chart showed price did exactly that. It souped the CRT low and tapped into the FVG.
Okay, so the H4 setup played out. What about the entry on a lower time frame?
Good question. You then drop down to the 15-minute chart. Here, you see the market purged that CRT low, tapped the key level, the FVG, and crucially, a Model 1 formed inside the 7 a.m., 8 a.m. window, right around the New York Open. That gave an entry opportunity at 7:45 a.m.
But what if you missed that? Is it game over?
Not necessarily in this case. The author points out that the 9 a.m. candle actually offered another opportunity. Price made an open low, tapped back into the Model 1 high, and then closed higher. It was specifically an OTE entry.
Ah, so two potential entries in that scenario. Show some flexibility.
It does. It highlights how even if 1 a.m. doesn't hit the level, you can still find setups by watching the 5 a.m. manipulation and using those lower time frame entry models.
Okay, let's look at example 102 then. This is where the 1 a.m. candle does reach the key level right away. How does that change things?
It simplifies the 5 a.m. job, essentially. On the H4 chart, 1 a.m. sets the range and taps the key level. Done. So now the focus for the 5 a.m. candle is purely on the manipulation part, watching for a soup of the CRT high.
Right.
And the example showed price doing just that. It tapped the key level, which was an old high in this case, during the 1 a.m. candle, and then the 5 a.m. candle souped the CRT high. Manipulation complete.
And the 15-minute entry, similar process.
Similar process, yes. On the M15, you see the market had already tapped the key level, then it purged the CRT high during the 5 a.m. candles time. Now, interestingly, in this example, a Model 1 formed during the 5 a.m., 6 a.m. window, which the author notes is London lunchtime.
London lunch, okay. Specific timing.
Very specific. And the author notes the setup provided one trade opportunity and price went straight to the CRT low. Basically no second chance, like in the first example.
So sometimes it's just one shot.
Seems so. And there's an important extra tip attached to this scenario. The author says, when everything lines up perfectly, key level tapped, CRT soup done, and Model 1 forms in that 5-6 a.m. window, then execute. Go for it.
Oh, but if not?
If it doesn't all align perfectly right then, the advice is just wait patiently for New York opening, 7 a.m. onwards. Don't force it.
That makes sense. Wait for the higher probability moments.
Yeah.
This second example really shows the precision, doesn't it?
It does. It highlights how some setups are just clean, one-and-done opportunities, while others might offer later entries.
Now, the author asks a really interesting question about these examples. Why didn't I take the 1 a.m. CRT or the first Model 1? What's the answer there? Why wait sometimes?
The answer given is quite direct and insightful. Always trade the beginning of the candle, not the end.
Ah, okay. Beginning, not the end.
Yeah. And they stress this applies across all time frames, daily, 4H, 1H, whatever. It's about positioning yourself for the start of the real intended move, not catching the tail end of a prior setup or exhaustion move.
That's a powerful principle. Focus on initiation, not culmination.
Exactly.
So, wrapping this up, the core model really seems like a fascinating blend of patience, precise observation, and time-based analysis. It takes the daily market churn and breaks it down into these understandable phases: range, manipulation, expansion. You can see why the creator finds it reliable.
Absolutely. And, stepping back even further, this kind of structured thinking,
Hmm.
it's useful beyond just trading, right? Breaking down any complex ongoing process into phases like setting the stage, testing the boundaries, and then making the decisive move. That can bring clarity anywhere.
That's a great point. It makes you think. And maybe that's the final thought for you, our listener. How could applying this kind of phase thinking, looking for a range, anticipating manipulation, and positioning for expansion help you navigate complexity or make decisions in your own field, your own projects, or even just solving problems day to day? Something to chew on. Thank you for joining us for this deep dive into the core model. We really hope you found these insights valuable.
Yeah, fascinating stuff.
Until next time.